You know, I've spent decades watching how government systems work, and I'll tell you something that matters right now. The Social Security Administration just processed payments that'll change how millions of Americans pay their bills this month. We're talking about $2,071 deposits landing in bank accounts as we speak, and if you're expecting one, you need to verify it immediately. Not tomorrow, not next week, today. Here's what most people don't understand about Social Security timing. These payments follow a precise schedule based on your birth date and when you first started receiving benefits. The system isn't random, it's methodical. And when payments arrive early or late, there's always a reason worth investigating. Right now, beneficiaries born between the 11th and 20th of any month should see their deposits. But here's the critical part that gets overlooked. Banking institutions process these transactions at different speeds. Some credit unions post funds at midnight. Major banks might take until mid-morning. A few stragglers won't show the deposit until late afternoon. The difference between knowing this and not knowing it, that's the difference between peace of mind and unnecessary panic calls to Social Security offices that are already overwhelmed. Now let me walk you through something that's been bothering me for years about how people interact with their Social Security benefits. I've watched friends, colleagues, and countless Americans approach this system with what I call willful ignorance, and it costs them dearly. They treat Social Security like it's some mysterious force of nature instead of what it actually is, a calculable, predictable system with rules that anyone can understand if they take the time to learn them. The $2,071 figure we're discussing today isn't arbitrary. It represents the average payment for retired workers in 2025, and understanding how the Social Security Administration arrives at this number tells you everything you need to know about whether you're getting what you deserve. See, the system calculates your benefit based on your highest 35 years of earnings, adjusted for inflation, not your last 35 years, your highest 35 years. That distinction matters enormously because most people earn their peak income in their 50s and early 60s right before retirement. If you retired early or if you had significant gaps in your employment history, your benefit calculation includes years where you earned $0, which drags down your average considerably. What fascinates me about human psychology is how people make irreversible decisions about Social Security without running the numbers. They claim benefits at 62 because they're worried the system might collapse, or because they need the money immediately, without calculating the lifetime value they're surrendering. Taking benefits at 62 versus waiting until full retirement age at 67 means accepting a 30% permanent reduction in your monthly check. 30%. For someone receiving $2,071 at full retirement age, claiming at 62 means settling for about $450 instead. Over a 25-year retirement, that difference compounds into hundreds of thousands of dollars in lost income. But people don't think in terms of present value calculations. They think in terms of immediate gratification and vague fears about the future. Here's something else that gets overlooked in all the Social Security discussions you hear on television and read in newspapers. The payment schedule isn't designed for the government's convenience. It's actually engineered to spread the processing load across the month so the system doesn't crash from everyone accessing their accounts simultaneously. If you were born between the 1st and 10th of the month, your payment arrives on the 2nd Wednesday. Born between the 11th and 20th, 3rd Wednesday. Born between the 21st and 31st, 4th Wednesday. Unless you started receiving benefits before May 1997, or you're also receiving supplemental security income, in which case you get paid on the 3rd of each month, regardless of your birth date. These exceptions exist for historical reasons related to how the system evolved over decades, and they create confusion, but the underlying logic is consistent once you understand the framework. The reason I'm emphasizing the importance of checking your bank account today is that discrepancies happen more often than the Social Security Administration would like to admit. Sometimes payments are delayed because of banking holidays that fall awkwardly in the calendar. Sometimes they're incorrect because the SSA adjusted your benefit based on updated earnings information or because Medicare premium deductions changed. Sometimes direct deposit information gets corrupted in the system and your payment gets sent to an old account you closed years ago. I've seen all of these scenarios play out, and the common thread is that people who catch the problem immediately get it resolved within days, while people who don't notice until they try to pay bills 2 weeks later end up in bureaucratic hell trying to expedite a replacement payment. Let me tell you about a principle I learned from studying psychology and economics for most of my adult life. People are remarkably bad at understanding systems that operate on delayed gratification and compound effects. Social Security is the ultimate example of this blind spot. You pay into the system for 40 or 50 years, and the benefits seem abstract and distant. Then suddenly you're 62 or 67, and decisions you made decades ago, whether to work that extra year, whether to report all your income, whether to understand the spousal benefit rules, determine your standard of living for the rest of your life. And most people stumble into these decisions without any real analysis. The spousal benefit rules alone could fill an entire course on Byzantine complexity. If you're married, you can claim a benefit based on your own earnings record, or up to 50% of your spouse's benefit at their full retirement age, whichever is higher. But here's where it gets interesting. If your spouse dies, you become eligible for survivor benefits, which can be up to 100% of what they were receiving. The strategy implications are enormous. A couple where one spouse had much higher lifetime earnings should carefully coordinate when each person claims benefits to maximize the survivor benefit that will eventually support whoever lives longer. But almost nobody does this calculation. They claim whenever it feels right emotionally, leaving enormous sums of money on the table. I've always believed that understanding incentives is the key to understanding systems, and Social Security's incentive structure reveals a lot about American society's relationship with retirement. The system penalizes early claiming and rewards delayed claiming up to age 70, when benefits max out at 124% of your full retirement age amount if you waited those extra 3 years beyond 67. This structure exists because actuaries calculated that on average the total lifetime benefits should be roughly equivalent regardless of when you claim, assuming average life expectancy. But here's the critical insight that most people miss. If you have reason to believe you'll live longer than average, either because of good health, family history, or lifestyle factors, then delaying benefits becomes one of the best investment returns you'll ever get. We're talking about an 8% increase in benefits for every year you delay past full retirement age. Show me another guaranteed investment with that kind of return in today's economic environment. The Medicare premium deduction is another area where people lose track of their actual Social Security income. The standard Part B premium for 2025 is being deducted directly from Social Security payments for most beneficiaries, and if your income exceeds certain thresholds, you pay an income-related monthly adjustment amount that can add several $100s to your monthly premium. High-income beneficiaries sometimes see their $2,071 Social Security payment reduced to $600 or less after Medicare premiums are deducted, and they panic because they weren't paying attention to the notices that SSA sent them months earlier explaining the adjustment. Reading the mail from Social Security isn't optional if you want to avoid surprises. Every notice they send contains information that affects your financial situation, and throwing them in a drawer unopened is a recipe for confusion and missed opportunities. Cost of living adjustments represent another dimension of Social Security that people fundamentally misunderstand. The 2025 COLA was 2.5%, which sounds reasonable until you realize that the inflation seniors actually experience in healthcare, housing, and food exceeds the overall CPI that determines the adjustment. The Bureau of Labor Statistics uses the Consumer Price Index for urban wage earners, which doesn't accurately reflect spending patterns of retirees who spend proportionally more on medical care and less on transportation and education than working-age people. This systematic understatement of inflation means Social Security benefits gradually lose purchasing power over time, even with annual adjustments. A benefit that feels adequate at 67 might feel insufficient at 82, not because the nominal amount decreased, but because 15 years of compounding inflation eroded its real value faster than the COLA formulas accounted for. The taxation of Social Security benefits adds another layer of complexity that catches people off guard. If your combined income, which includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits, exceeds certain thresholds, up to 85% of your benefits become subject to federal income tax. For a single filer, that threshold is just $34,000. For married couples filing jointly, it's $44,000. These thresholds were set in 1984 and have never been adjusted for inflation, which means millions more retirees get caught in the taxation trap every year as nominal incomes rise while the thresholds remain frozen. Planning withdrawals from retirement accounts strategically to minimize the taxation of Social Security benefits requires sophisticated tax planning that most people never undertake. I want to talk about something that doesn't get nearly enough attention in discussions about Social Security, the work penalty for early claimers who continue earning income. If you claim benefits before reaching full retirement age and you continue working, Social Security will withhold benefits if your earnings exceed certain limits. For 2025, if you're under full retirement age for the entire year, they withhold $1 in benefits for every $2 you earn above $22,320. In the year you reach full retirement age, they withhold $1 for every $3 you earn above $59,520, but only counting months before you reach full retirement age. Once you hit full retirement age, the earnings test disappears entirely, and you can earn unlimited income without any benefit reduction. The withheld benefits aren't lost forever. Social Security recalculates your benefit at full retirement age to account for the months they withheld payments. But in the meantime, you're dealing with reduced cash flow that could create serious financial stress if you weren't expecting it. The divorced spouse benefit provisions reveal another aspect of Social Security's complexity that can work tremendously in your favor if you know the rules. If you were married for at least 10 years before divorcing, you can claim benefits based on your ex-spouse's earnings record, even if they've remarried, as long as you're currently unmarried and you're at least 62 years old. Your ex-spouse doesn't need to have filed for benefits yet, as long as you've been divorced for at least 2 years. And here's the beautiful part. Claiming on your ex-spouse's record doesn't reduce their benefit or their current spouse's benefit in any way. It's free money that many divorced individuals never claim because they don't know it exists or they're too proud to pursue it. I've never understood letting pride prevent you from claiming benefits you legally earned through a decade of marriage. The disability insurance component of Social Security deserves mention because it protects workers who become unable to work before reaching retirement age, but the qualification standards are stringent. You need to have a medical condition that prevents you from performing substantial gainful activity, and that's expected to last at least 12 months or result in death. The SSA denies the majority of initial disability applications, and the appeals process can take years. Meanwhile, applicants struggle financially without income. The system is designed to prevent fraud, which is understandable, but the collateral damage includes legitimately disabled workers who fall through the cracks. If you're considering applying for disability benefits, document everything meticulously, get your doctors to provide detailed evidence of your limitations, and be prepared for a long fight. The approval rates vary dramatically depending on which administrative law judge hears your case, which introduces an element of randomness that's frankly disturbing in a system that determines people's financial survival. Representative